Susan, your video is still on. Welcome everyone to NAAIM Confidential Live.
Wow. Hey everyone, welcome to NAAIM Confidential. This week, I'm this week's host, Ryan Redfern. Today we have Dave Moenning from Heritage Capital Research. Hey Dave, good to see you today. Thanks for
Nice.
being here.
Happy to be here. Happy holidays.
Nice, thank you, thank you. I know we're going to dive first into the NAIM Exposure Index as we always do, and I believe, are you a contributor to that index?
Yes, I am.
Well, and what is your current exposure to that, if I may ask, if you don't mind sharing?
We're at 100%. I vacillate between using, I run several different strategies. So I'm trying to give something, a number that's representative of the overall theme or the positioning that I have overall.
Of course.
So long and strong at this point. So
Even with
yeah,
today. Yeah, and the
yeah,
index was at 97.13, so you were bringing up the average. As was I. I reported 110 this week, so I was up a
nice.
little bit too. So
Yeah,
today
good.
kind of sucked for me, but but it
Yeah,
wasn't. Actually, we own a lot of like Dow and real estate and consumer discretionary, so it wasn't terrible, but it wasn't great. It's never days like this are never great. So all good. All right. Anyway, any last wisdom on the name exposure index? I know you've been around since its inception, so.
well, I think, yeah, we renamed it many years ago
Mhm.
because it was being viewed as a sentiment index, and it's not a sentiment index.
Mhm.
We thought long and hard and went round and round, but we finally renamed it the exposure index to let people know that these are the exposures
Right.
that actual money managers actually have with client assets. This is not I think market should go down here. And I think that's valuable. And and it's cool to see the numbers reported in Bloomberg and CNBC and even Ned Davis Research includes it. They've been
Yeah.
including it for years, so it's nice that we're getting some recognition there. Um,
Mhm.
use it as a contrary indicator at your at your own risk, because the trend is your friend, and when the trend
Yeah.
is moving, when you got a nice trend, as a whole, the timers and NAIM are trend followers or tend to be
Mhm.
trend following it. So I think it's a good indication of where the market's at. I mean, look, anything above 80,
Yeah.
you can compare down to the S&P 500 where it went above 80, and it's been sitting there, and it's been a nice
Yep.
up and to the left since. So
Absolutely correct. And it's much better than the AAII, who's been bearish this whole time.
well, sentiment numbers have been really interesting this year.
Mhm.
I'm going to go off on a tangent on that real quick, but
Do it.
sentiment's been really interesting because sentiments among consumers have been really weak, and we finally figured out about midway through the year that this has to do with political leanings.
Mhm.
If
Oh
you're
yeah.
if you're Republican, you're loving life. Everything's great, everything's going our way.
Right.
Democrats, the sky is falling, everything's terrible. I'm going to lose my job, inflation. So it's you really can't get a good reading on sentiment for today because you've got this bifurcated economy, you got a
Yeah.
bifurcated market, you got bifurcated consumers, the K shape. So
No, you're absolutely right. No, this if any year is his opinions have been relevant to the market, depending on your political, it's been just absolutely wild seeing how the divergence has been so big on
massive.
both ends. Usually it's like, oh, I lean a little this way, a little this way. No, it's either terror or the massive optimism. There's like no in between. It's
Yeah,
crazy.
yeah,
But
totally. And so you can't. I mean, my one of my battle cries is you have to adjust to the market conditions. You got to change with what the changes.
yeah,
It is what it is, right? It's not what you think it should be. So this is the year where you have to adjust how you use your sentiment indices and how you use that data. Because breadth is another situation which is a little weird, a lot weird this year. And if you're focused on, oh, I need a full participation in the market, well, you've had a rough 3 years.
yeah,
Uh, so
it's true. And volatility's been there. So
yeah.
absolutely. Well, I wanted to kind of dive in. Let's start with talking about your background. How did you get to where you are today? Any highlights along the way, in the active, with the lens of active management? I mean, that's kind of the
Yeah.
point is how did we get there? We all came here from different means. So I'd be curious how did you get here, where you are today?
Well, I got here from almost day one. I
Nice.
was an athlete in college and a financial advisor guy who had a shop in Illinois came to the college I was at and recruited athletes because he thought athletes made good business people. And they're like, that's probably a good idea. So I ditched my
Mhm.
computer science career and threw that
Oh,
right down a hole and went into the wonderful world of finance or financial advisory, which at that time was selling mutual funds and insurance.
yep.
Financial planning wasn't even really a thing in 1980. Um, but what was interesting was one of the things we were selling was a market timing service
Mhm.
from a guy out of Houston. So I was introduced to a thing called market timing, buy low, sell high,
Right.
way back when, and I thought it was a pretty cool idea. What I learned later was that when interest rates are paying you 8 or 9% on your money market fund, market timing is a lot easier. You
Sure.
earn market rates sitting in cash. So,
Right.
but anyway, I started there. Being a 20-something-year-old, I quickly figured out that the clients that I had didn't need fancy estate planning or any of that stuff. They needed their investments to go up. So I gravitated toward the stock markets, really enjoyed it. I still view it as a great big game, not to be taken lightly, but it's something that's
Yeah.
constantly changing. It's a moving, living, breathing thing that's fun to play with. So my partner and I started managing money in the summer of, wait for it, 1987. We were fortunate
Perfect.
enough to move I think it was like 3 or 4 clients to cash in August like 5th
Whoa.
of 1987. Missed the crash and we were in
Mhm.
business. So that started. So my early exposure to market timing and then actually doing market timing myself, that got me into the whole risk management world. My early heroes were the late Marty Zweig,
Oh yeah.
Ned Davis, Stan Weinstein.
Mhm.
So I've been exposed to the concept of risk management from day one. Have always loved it. Started my own firm in 1989, Heritage, and the focus there was, I was a trend and momentum guy that managed risk along the way. So then after a brief stint as a CIO in 2015 through 2018, I came back and starting in 2018, I've been a consultant, a portfolio management consultant to investment professionals since then, and have really enjoyed it. Because the difference, you deal with retail clients, I deal with people like yourself. So
Right.
when someone calls up and when an advisor calls up and is being hysterical, I can tell them, look, you're being emotional, just stop it.
Yeah.
You can't tell a client they're being dumb. Um,
Not
so
always.
yeah. So now, now I do work with I do sub-advisor work, I do signal work, and I do consulting work. We run 4 funds. I work for a family office, and I really enjoy that.
Mhm.
So that's been really great. Uh, so.
That's fantastic. Well, so how does that, I mean, you kind of hinted into it as you've been active since the beginning. Is there like an overarching investment philosophy that you have?
Yeah,
Excuse me.
yeah,
And your
I've got
approach
three.
to the markets? Yeah.
Yeah, just so everybody knows, I got my key name notepad here, my
Love
handy
it.
dandy notebook. Um, if you can't tell, we got grandkids tonight, so I'm sure Blue's Clues are going to be in there somewhere.
Yep.
Anyway, there's 3 keys to my philosophy.
Okay.
First of all, I've learned my early days in timing. Then we remember in the 90s, the mutual fund industry came out against timing, time, not timing,
Mhm.
and everybody told everybody that timing was
Yep.
stupid. You can't do it. It's like, well, all I got to do is follow. Even a 200-day beats you guys. But anyway, but I've morphed quite a bit. I now believe in getting it. I think the goal is to be mostly right most of the time. And that may sound simple, but it's really critical. I don't want to, if you stretch too far for returns, if you work too hard to, outperform, you run the risk of dramatically underperforming. And in my world, the key is don't get somebody fired. Don't get the advisor
Yeah.
fired. So we've got to figure out ways to add alpha without providing the opportunity for the huge miss.
Mhm.
So getting it mostly right most of the time is really the key. One of my big philosophies. The second is I'm a big believer in understanding on a daily basis why Ms. Market does what she does.
Mhm.
Um, if you understand why on a daily basis, then you're probably not going to get fooled on a weekly or monthly or even quarterly basis, and you won't wind up with closing out a year like 2025, go, huh, what happened here? So, I do try and understand the why, understand how the game is played, who the players are, what's driving things. This is a really classic example of a rotation going on. I don't know how long it lasts. Rotations have been very brief over the last few years, but we'll see. And then the third key philosophy, I guess there's four actually. The third one though is
Sure.
there's three ways to add alpha. There's timing, selection, and leverage. Timing is when you buy and sell. Selection is what you buy and sell, and then the leverage or position sizing is how much you buy and sell. So, you have to understand that there's those three ways that you can try and outperform. As a money manager, we have to outperform in order to get paid, right? I mean, if we underperform year after year after year, somebody eventually is going to say, "Why am I paying you?" So understanding those three levers that you can pull in a portfolio is really important. And then what the limitations of each are. For example, to take rotation of, say, sectors, some years, sector rotation is an easy way to outperform. Other years, it's a nightmare,
Yeah.
and it can really hurt you. So understanding how these different strategies work is really important. And then the fourth thing is that I've become a multi-methodology, multi-strategy investor. I believe that is the modern way to diversify. Yeah, you got to have different asset classes, you got to have different geographical regions. But what we've learned during crises is that, when what hits the fan, the asset, they all go to one, they all follow stocks.
Yep.
So there's only two asset classes at that point. There's government bonds, and then there's the U.S. stock market. So how do you deal with that? And so the answer that I've come up with is to utilize different methodologies. And by methodologies, I mean passive, strategic, tactical, selection, and alts. Those are the different ways you can manage money. So you want to have different, allocation approaches, different strategies. You also want to have different managers. Wherever I can, I try and use, if not a different manager besides myself, at least a different research provider.
Yeah.
Because every manager has their own view of the world, Ryan. I'm sure you do. I'm not sure exactly what it is, but I do read your blogs. I'm getting closer, I think. But you can usually tell if someone hands me a stock portfolio, I can usually tell you what kind of investor they are, what they think, what they believe in. And so you don't want to have all your eggs in any one basket. So, if you look back over a long period of time, there have been times on a passive approach, which, that's the evil for us, right? But there have been times when a less active approach has been, buy and hold has been, very successful. There have been times like 2000, 2022, 2008, where a tactical timing risk management approach has been very successful. The problem is you don't know, I'm sorry, to continue, over the last 3 years, the selection approach, stock picking has been massive. I mean, you can provide significant outperformance by being in the right place. But that's not always the case. The problem is, when does one methodology go in favor? When does it go out of favor? I've never figured out a way to figure that. And you also run the risk of being wrong. So the idea is to diversify by methodology, diversify by strategy, diversify by manager. And if I can, like in the funds, we have as many as 6 or 7 different managers at any one time. And the more I hate that one manager's approach, the more important it is to include that approach in the diversified strategy. So mostly right most of the time, understand why the market's doing what it's doing, understanding the ways to add alpha, and then using the multi-methodology approach has really been, those are my key philosophies to making this game work.
Nice. Now, a couple of things that stand out is like you said, correlations go to 1, right? I'm thinking 2022. You used to be really before COVID, you could go to treasuries when the market was having a bad week, month, whatever, and do pretty well. That stopped, like abruptly stopped. And that was a pretty dramatic time. And you definitely have to pivot and go, okay, maybe not there anymore. Did you guys have to do much dealing with that, or was that built into the strategies?
That was built in. What not built in is, again, the understanding why. What was going on there? Well, ETFs were breaking. Mint broke for a hot minute there. If Mint doesn't work, we're kind of screwed.
It's true.
So all kinds of things weren't working. So you really had to understand what was going on. And then, from a timing perspective, you had to understand what was happening with the
Yeah.
rebound and what was happening with those securities. So that was a great way to understand that ETFs, even though they say they're liquid, they're not always liquid. So if you get into a severe crisis, the liquidity is going to go away. Stuff starts to break. That's one of the phases of a crisis. Understand when we have forced liquidations, when ETFs start breaking, people start liquidating their portfolios, that's when you know you're near the end.
Wow. To some extent, doesn't that really make the case for mutual funds over ETFs? I mean,
Does.
I'm leaning more and more ETFs, but I found in those crisis times, I can get out of a mutual fund end of day and I'm probably going to be out. ETFs, you don't always know.
Yeah,
You
and
got to
then
find a buyer on the other side.
don't forget what was it? The volatility blow up. It was called Volmageddon. Volmageddon.
Right.
That's what it was.
Right.
Those just two ETFs just went under. I mean, sorry, we're done.
Yeah.
You've lost all your money. I know a couple name members that did lose all their money in that trade. Not
Oh,
all
wow.
their money, but all the money in that specific position. So, yeah. So understanding what can happen is really an important part of the game, an important part of your risk exposure. So yes, you are correct. You can make them. And I still, for my signal business, I still recommend Ridex to people for that specific reason,
Yeah.
because you know what you're getting.
Yeah.
Unless you're going to do, a VWAP or a TWAP
Yep.
for all day, buying every minute for the next 6 hours, unless you have the ability to do that, it might be better to just get the end of the day price and know you're going to get the end of the day price.
Exactly.
One of the important lessons I learned a long time ago was I thought it was so cool. This was probably 15 years ago, at least, maybe 20. I made a buy in an ETF in the last minute of the day, and I wound up with a $1 premium over the NAV, or I wound up paying a $1 premium. And that was a big. It turns out in the last minute, it doesn't trade at NAV. It trades at whatever it's going to trade at. So important lessons.
Nice. Yeah, no, awesome. And I was also thinking, and kind of to go past that is more from as an active manager, I find that money flows come to us very aggressively when markets are bad. But the funny thing is they should have done it now when things are great. And then they come to us and like, oh, hey, you're going to protect our money. I'm like, yeah, we did, but now you're late. But saying that we find huge inflows when these bull runs stop, and I just find that fascinating cycle to the business. I'm curious, how does that factor into what you do as well?
Yeah, that's a classic tale. I mean, investors always want to buy the chart, right? They want to buy the mountain chart. That already happened, folks. You can't have that. You got to go what's ahead. We don't know what's ahead. So I think proving the ability to manage risk in a true bull bear cycle, the bull, you get the euphoria, everybody's great. This is an easy way to make money. You can't lose, blah, blah, blah. That's when bubbles happen, by the way, people. Not when everybody's arguing about it every day. But then, you get the panic, people feel dumb and they sell out. And then they say, well, like one of the firms I work with works with athletes, NBA, NFL players. And so we talked to a young kid, just got his first contract, and the dad got on the phone and he was Indian. And he said, Dave, I am so bad at this investing thing. I have to hire someone who knows what they're doing. I'm so dumb. It's like, it has nothing to do with being smart or dumb.
No.
It's about understanding the game. And so most people go the other way. So they want to find somebody to trust. And if you guys demonstrate the ability to manage risk, that's really the key. And in my world, I've really gone from trying to time 5 and 10% corrections, did that 25 years ago. That got really hard starting in 2011 when high-speed trading took over. Mean reversion became a key to the game and it made it really hard. So I'm more of a bull bear timer. I want to invest in different strategies. We do stock selection, we do strategic allocation, we do hedging, we do risk management. You combine all that together and you should get a smoother ride. But I'm not gonna start lightning or doing any hedging until it looks like the bull has run its you can't guess, but until things start to really roll over. And then same with the other way, when things get really, really bad, buy when there's blood in the streets, right?
Absolutely. I have a couple thoughts there, but I know one was you said you really don't buy on the 5% dips, but we've been getting nearly 20% they're like 19.8. I guess that doesn't count as 20, but I think if you count the little gray area there, we get them like what, every other year now?
Mhm.
It's supposed to be every 10 years or something like that. It's like, no, no, no.
Yeah.
This is every
You
2
get a
years now.
10%er every year. You get 3 5%ers. You're supposed to
Right.
get 120, But again, everything is sped up. The
Yeah.
time frames have all been compressed. They continue to get compressed. And
Mhm.
so that's why as time frames get compressed, my view of timing, and again, I have big tax consequences with a lot of my clients too. So the people who want to trade, yeah, we can trade.
Yeah.
But for the tax sensitive people, we've got to be longer term.
Mhm.
So
Right, right. But what I wonder is the new generation. I certainly hear from younger people think that the market only goes up, or if it goes down, it's back up in a month. So don't worry about it. You just buy those dips. At some point, it's not going to be a buy the dip situation, right?
correct. Right, but I mean, right now, I think it remains a buy the dip situation
Right.
for one reason and one simple reason only.
Mhm.
The consensus estimates for S&P 500 EPS in 2026 are it's above 14%.
Yeah.
So if you've got, we had 12 or 13% in 2025. If you've got double-digit earnings,
Yeah.
then it's a buy the dip game. If
Mhm.
you've got, and there's no recession. Again, we've got the bifurcated economy. And real quick on that, if you don't know what that is, consumers making 100 grand a year, they represent most of the spending, more than half the spending in the U.S. Well, 70% of GDP is consumer spending. So if the haves don't care and they're just spending willy-nilly because their life isn't impacted by 4% inflation or whatever tariffs, they don't care about any of that. Whereas the low income earners, they're worried about their job. They've got inflation impacting cost of gas, all this good stuff. So it's really you got to understand the macro picture. So right now you've got a positive macro picture. We got a friendly Fed. We've got positive earnings. We got an economy that's going along. Inflation isn't high, and then the one negative is valuations.
Yeah.
And by the way, just to plug the name, name indicator wall that we do every week.
Mhm.
In that wall every week, there's a fundamental board, and it's we do a rating of earnings, economy,
Yeah.
valuations, all that good stuff. And it's real easy. Green is good, red is bad.
Right. Super simple. And the other thing I think is going to tie in great with that is you were talking about how you had an investor or the investor's dad who said he was dumb because he was probably looking at fundamentals. And I can't think I've met so many people who have gone through finance courses in college and like, this is what the stock market does. And then they go and practice and it's like nothing, none of this works. Right.
Exactly. Well, that goes to the why.
Yeah.
I'm a Dr. Why. Why did this happen today? Well, today for example, we started up a little bit, and then the headline comes out that Oracle is going to have to delay the opening of their OpenAI data center in southern Michigan for a few months. Suddenly that flipped a switch, and traders decided the rotation trade is back on. And we
Yeah.
are going to continue to short the AI trade like crazy because that's the trade that's happening right now. It is clear as day. That's a trade. There wasn't, there wasn't a whole, group of consumers who suddenly said, "Oh gosh, that headline that really changes things. Maybe we
Right.
should rethink this." No, that's trading.
No, no. If I recall, like advanced decline was actually up today,
Yeah.
in the middle of all this, and new lows, no new lows, like 10. That's a number that's just non-issue. So I think that's interesting. And wasn't the Dow was up most of the day? I think it did close
Yeah.
negative, but you're watching the Nasdaq and tech fall apart, but there are parts of the market that like didn't seem to care.
Well, on the falling apart thing, let's remember these spec areas had gotten, when stuff doubles and triples in a matter of months,
Mhm.
guess what? They're gonna knock it down 30 to 50%. It's not if, it's just when.
Right.
So don't be surprised. I learned from William O'Neill a long time ago that
Yeah.
a normal correction for a growth stock, a leader, in any time frame, a 20 to 25% pullback for a growth company is normal. It's not the sky is falling. That's just the way it works. 2 steps forward, 1 step back, 2 steps, off you go. So what's happening right now is the stuff that's up 100 to 300% on the year is getting, it's getting it taken out behind the woodshed. Sorry that, the quantum stock's only up 300% now this year instead of 500.
Right.
The 500 was kind of silly if you ask me, but
Yeah. But it's all
still,
relative, right?
yeah. Nobody has a working quantum computer, by the way, yet. So
Not yet. Not yet.
it's coming.
They keep saying that, but then hard to say. Then do we have the power? Well, that would be a low power thing. That's a whole different conversation. Are there any big picture indicators, things that you like to use in your research that are worth checking out? You know, kind of a high level. What drives your investment decisions for the most part?
I guess I would have to consider myself a macro person.
Okay.
I kind of take the entire picture. The reason we started doing the indicator wall was to look at everything every week
Mhm.
and just say, okay, well, here's what trends are doing, here's what momentum's are doing, here's the valuations, here's the monetary, here's this, there's that, political. So kind of try and first question is do I want to be in, where do I want to be? Do I want to be in the stock market or out of the stock market? And as long as the fundamentals are positive or favorable, then I think history shows you want to be long equities because they compound at 10% a year since 1980. That's not bad. Money
Right.
doubles every 7 years that way. So, and then from there, very nuanced. We want to have, we want to build a blended portfolio that
Mhm.
provides a nice, smooth as ride as we possibly can produce, right?
Mhm.
So we don't want to, we may have a very aggressive, by the way, we've dramatically outperformed over the last 3 years because we've had a small sliver
Mhm.
of the uber growth portfolio stuff in there. We're looking to the future and say, where is the growth? Well, it's in AI, it's in, the bricks and mortar of AI, it's in
Yeah.
energy, it's in robotics, it's in,
Mhm.
quantum. This is where the future is. And yeah, it's going to be a bumpy ride, but when
Yeah.
if you can add that portion of your portfolio that is, providing significant outperformance,
Mhm.
then you don't have to get it right on your timing.
Yeah.
Um, so so yeah, I think first thing is do we want to be in stocks? Should we be out of stocks? To what degree? And then more importantly, what type of environment are we in? And that will dictate what strategies you
Sure.
should use. Simply put, should I be in trend following or mean reversion?
Right.
Some years mean reversion is all the rage. Other years it'll kill you.
Yeah. Oh, absolutely. Absolutely. Oh, we're kind of coming up on time and there's so many more things I wanted to ask you, but I guess we'll have to start to wrap it up. So I always like to close these with, do you have a favorite investment quote that drives your opinions?
Yeah, I do. It's probably, the mostly right most of the time thing is my mantra. But
Yep.
my favorite quote came from Ned Davis, and it was the title of his book. And it's not about being right. It's about making money. And
Mhm.
so I've adapted that to it's not about being right, people. It's about getting it right.
Mhm.
So nobody cares if I'm right. They only care if
Right.
their portfolio gets it right. So
Exactly.
that's my favorite cry.
Love it. Love it. Fantastic. And then, of course, are you going to be, and we've got NAAIM Outlet, or sorry, UK coming up in April 26th to 29th in Tampa, Florida. Are you going to be there?
Absolutely. I have found that these conferences are invaluable, right? And honestly, now that you've added CE in there, thank you, thank you,
Yes.
thank you.
Oh, you're welcome. I'm technically the teacher of it. So yeah,
You are. So
I am.
that was wonderful. When I asked my compliance guy, I said, "How many hours do I?" You got
Yeah.
7. It's like, how did I get? Oh yeah, excellent.
I know we need to push that more because it's included in the price. I mean, it's just if you want it, it's there. And if you show up for your session, you sign in, sign out, done. Great. We
You
can
just eliminated 7 hours of misery in December.
exactly, exactly. I'm glad you appreciate that and take advantage of it. I know I do
I
myself.
do.
It's
I will be there if nothing else. I
to
mean,
get to see.
no, it's really I took something away from our call before this call,
Mhm.
and like Paul always says, he will get something, some nugget to help
Yes.
him in his business every single time, and that's worth the time and money to get there.
No, I absolutely agree. And I have every single time and I keep going back and I can't help it. And like you, I became a president.
Yeah, they talked you into it, didn't they?
We all did it. It hit me,
It's
you,
it's a
Paul. Yeah,
it's a love thing, right?
it is. It is. But even when I'm done, I'll still be going back. I enjoy it that much. I really get that. I mean, getting to know you, getting to know all these people really makes a difference in my business and how I do things. Gives me better, an outside opinion, way to look at things. It's just so beneficial.
Real quick, one last thing for you is that
Yes.
my multi-methodology concept came from NAIM as a
Mhm.
group of us got together, about 7 of us got together a decade plus ago and decided we'd try and blend stuff together.
Mhm.
And that's what came out of it is people have different opinions and everybody is very vehement of it in their view.
Right.
And nothing else is correct. Like, well, no. So the concept of blending things together really came from name people. And so I got to say thank you for that. That's been awesome.
Absolutely. I think that's a great place to stop on it. Well, thanks, Dave, for being here. Great to see you. Always great to talk to you. I
Thank
will
you.
see you in Tampa in April. All right. Thanks,
Sounds
everyone, for
great.
being here. We'll see